What are some practical reasons why you might want to load up on debt? Hi, this is Justin Hitt with Sustainable Wealth Secrets. Now, you know that what I share with you is contrary to the mainstream advice about money. I'm actually going to share with you today why you might want to load up on debt. There are actually times in the economic cycles where loading up on debt is a good thing. Now, I'm going to give you some practical reasons, but it doesn't mean you need to go out and start borrowing a bunch of money. There are other factors to consider. This is just a short podcast, but I want to introduce you to the concept that actually breaks all of the misunderstandings about debt being bad. Debt can actually put you in a position to gain control over assets and to otherwise improve your financial position, especially in the case of inflation. So, let's talk about the first one right here. You can actually use other people's money to bootstrap a winning idea. Let's say you have some insider talent and you're practically using it in the marketplace, you're applying it, you're generating a small amount of profit, and if only you could afford better equipment, if only you could have a better facility, if only you could be able to reach a larger market, you can actually take your winning idea and bootstrap it. So I'm not talking about borrowing $1 million. I'm talking about what's the next level for what it is you're doing today. And if you could use other people's money, that's either borrowing or taking on investors or simply getting an equipment loan or lease, or we talk about debt. There's all kinds of ways to get debt. Most of the ways to get debt are very easy for high-income professionals, yet very scary if done the wrong way. But you can use other people's money to bootstrap a winning idea. Notice I didn't just say you can borrow money to chase a harebrained idea. No, you have to have some proven success. Next, you can borrow money to increase earning capacity. Now, this is very important. Let's say you're a high-income professional and you're really up against a wall when it comes to that next level position, but you noticed individuals with certain certifications, certain types of education, or certain investments in themselves were able to get to that next level. So let's say you're a lowly old accountant and you're pushing up on six figures, and now you've got the opportunity to now become a certified public accountant. So you're in the industry, you're making $80,000, $90,000 a year, and you know that if you invested in your education, you could become a certified financial planner. You could be a CPA, certified professional accountant. There's an opportunity here. Now, how do we approach that? Well, we look at the value of that investment. I was looking at an MBA program, and they wanted $53,000 for an MBA program. Now, first off, would that MBA program add $53,000 to my income over the next 1 to 2 years? It's possible, but if you add that to your current earnings, you could see whether you're still going to be in the same job category, whether you're going to be in the same area. In my case, spending $53,000, I don't guarantee a $53,000 increase in my current year. I like to have a 12-month return on investment. However, I could see that in 2 years. Now, I could see it because of inflation, and that's a different story. And it's actually one of the reasons you would borrow money, is because even if you had the cash to invest in your education to increase your earning capacity, you may want to actually borrow the money because the cash can earn more in the marketplace. And then in the case of inflation, you could borrow the money now, invest in your education. Say it costs $24,000. Very easy to add $24,000 to a high-income salary. You could borrow the money and then pay it back with the increase in earnings or a percentage of your income, rather than taking money out of your emergency fund, or rather taking money from stock investments or liquidating investments, because you've analyzed the situation. How about this? You can borrow money, in fact, to increase cash flow by refinancing debt. A lot of clients saw that the mortgage rates were down so low. They were just falling. And when they looked at the refinance of their mortgage, including closing costs, they were able to, in many cases, cash out of properties, take equity out of the property. You don't want to take it all, but you take some equity out of the property. Take the equity out of the property, buy another house for renting out, that produces cash flow, and their payments would still be less than their payments were with an old high interest loan. So you can actually borrow to refinance and actually lower your payments, increase your overall cash flow, and get better interest. It means your cost of capital is lower by borrowing. Now, I can come up with a whole giant list. I got 2 more items here, but I want you to think about this. Media tells you borrowing is bad, yet businesses and really wealthy individuals borrow all the time. What is bad about borrowing? Well, it's very often the skills that you approach borrowing with. So, for example, if you're just going to borrow money to go buy a boat, that's not as valuable as using debt to control cash flow and gain leverage. If you knew somebody had a $1,200 a month cash flow and you could invest in that property, in that activity, in whatever it is, and you could get a percentage of that $1,200 a month cash flow, and you could borrow the amount of money that you need to get into that position for $300 a month, and they split the cash flow with you, now you're getting $600 a month in cash flow. The money you borrowed to gain that position cost you $300 a month. You're actually $300 a month ahead using someone else's money because that debt controls the cash flow and gains leverage in that relationship. Now, of course, if they've got a bad idea, you don't want to borrow money to invest, so you've got to know how to do the math. Most of what we talk about with Sustainable Wealth Secrets is being able to do the math on paper, not on some fancy spreadsheet. Being able to actually do it on paper. Is the math so easy that you could grab a pad of paper and a pen and you could run the numbers? If it requires you to go to financial models and look on a stock market index and drill down into a bunch of other info, it's too complex. And you're not going to be able to have the win side of the arrangement by, of course, having positive net cash flow. The last reason you might want to borrow, it's actually not the last one. Again, there's hundreds of reasons you can borrow money, hundreds of reasons why an individual doesn't want to borrow money. But you can use a debt instrument to control an asset. So in all these situations, you could actually, if you found a business that works well, you can borrow money or create a loan with a debt instrument so that now you can control an asset. So you will borrow money on a mortgage in order to control the asset of a home. Now, that's a perceived asset if you're living in it. It is an actual asset if you are now renting the home out for more than what the debt service costs. See, does that make sense? And how do you do the math for that? Well, you look at the investment property. You figure out what maintenance needs to be done. You figure out what your holding costs would be. You figure out what taxes might be in the future. You add up all those numbers. Then you determine how much money you have to borrow, how much money needs to be in a reserve to have maybe 6 months of payments in place. And then you roll all of that into a number that will give you your expected payment on the amount borrowed, but it also gives you kind of an expected monthly expense. Now you can go back and forth figuring out what kind of cash you need to have available, but then you can come up with the amount you have to borrow. Then you're going to look at what the interest rates would be. That's going to be based on your payment. So if you want to borrow $100,000 and you need to have a $1,000 a month payment, that's a different interest rate than borrowing $100,000 and having a $500 a month payment. You also want to think about terms. All these things fit on a sheet of paper. Once you've done the math, you can then see what is going to be your holding costs, what is going to be your cash flow, what's going to be your potential income, and then you can project at a discounted price. What does that mean? Well, if you've got a rental property, you're probably only going to keep a tenant in it 85% of the time, and therefore you want to discount the income and look at it from that perspective. If you've got major repairs that are going to come down the line, you want to build those major repairs in as part of a reserve. Now, again, I'm just off the top of my head giving you these factors for a house. It would be different if you're buying a truck for a business, if you're buying equipment for a restaurant, if you're buying, you're downsizing your home, renting out the existing home there's tax ramifications because you might become an active investor, or if you list it with a management company, you might become a passive investor. So you want to look at the tax factors, the other factors involved. The key is that it's not rocket science. And once you're familiar with these terms and the structure, that's why I call it a debt instrument, you can structure how to approach the specific situation. And you know what's interesting? Sometimes you don't need to borrow the money. You can do partnerships, joint ventures. You can, help a business out with services. I've done debt instruments to offer an organization capital, but didn't actually have to deliver the capital because I supported them in a business development position. The promissory note was actually used to make sure I got paid. So they paid a promissory note and got services. They never actually got any cash up front. And there's different ways of doing this. Now, I talk about how you can get paid, and there are ways for you to use debt to get paid. So, for example, an accounts receivable with an organization is a loan. You've done services for the customer, you've expended resources, and the customer will pay you back in the future. You've extended credit to them. There's models where you can borrow money from one bank, have them pay it to another bank, and then have a third bank pay you out some kind of equity. And that might be the case where you're buying out a mortgage or you're buying out an interest in I use real estate as an example because everybody lives in a house or some kind of building. But ultimately, you can do this with vendors so that you can get equipment and inventory without having to pay for it. Now, the bank is going to own the inventory, but you've got a position to sell that inventory. So you have the rights to sell that inventory. The bank has acquired it for you. You have the rights to sell it through some kind of existing contract. Maybe you have a backlog in a manufacturing company. And so that third party will then pay the money you borrowed, and you're going to keep a little slice off the top. It could be called flooring in some industries. Here's the point, though. When inflation is coming, you're actually going to pay back the money with inflated dollars. You're going to get use and value of the assets right now, and you're going to have the opportunity to cash flow. Now, we have a system for doing that in the Sustainable Wealth Secrets membership, and we talk about ways you can do this. And in fact, we discuss about the efficiency of money. We talk about leveraging against inflation. We talk about a system for debt management. You know, if you go out and get 10 or 15 different loans, it can be very difficult to manage. If you have 10 5-year loans, you're going to be paying a lot more every month than a mixture of different time periods. We talk about the power of free net cash flow, because I know a lot of folks with high incomes, banks want to give you money like crazy. They want to give it to you because you know why? Debt handled the wrong way is slavery, because they know you have earning capacity and that you're good for the money and you're going to pay the bill, but they can actually get you in a system where they start rolling you over. And now you're reoccurring income for them. You're free net cash flow for them. They weren't doing anything with the money anyway. Why not loan it to you? That way they get money every month and a legal contract in the debt instrument that if you ever fail to pay, they can come take that house that you mortgage. They can come take that vehicle. They can come take things from you in order to make the debt whole. Now, you're always going to promise you can pay it back, but things change in the future. So what I'm really talking about here is the skills are more valuable than whether you are debt free or you have debt, because when you understand how the money system works, there are times when you might be loaded with debt. I'm going to leave you with one example. There are several cases of famous individuals who had a lot of cash yet borrowed everything they could. So I think Elon Musk is one of those examples, had a large amount of cash from PayPal, tied it all up in the business, the equity of the business, the Tesla, and then borrowed against Tesla to manufacture the vehicles. At the time of the startup, he's living on someone else's couch. He barely has any cash, but it basically took the cash he had, put it in a structure, which was a business, and then borrowed against the business and ended up having the original money plus the money borrowed, and then the increase in value when the company went public. There are plenty of examples. You don't have to be Elon Musk to do this. I've known businesses that borrowed money. They had a contracting company, and their shop was getting a little small, so they borrowed money to buy a bigger shop, which was way bigger than what they needed, and actually leased out the excess space to create cash flow that paid for the overall building. And so they ended up getting a free building. Now, what this person did was actually bought the building under a real estate holding company rather than the contracting company, so he gained cash flow from his own contracting company. He lowered the rent for the company by $1, got them more square footage, and ultimately got paid twice for the purchase of the building. Now, if you've got questions about this or anything else we covered, if you've got a specific deal that you'd like some insight or an approach to, contact me at www.insidestrategicrelations.com. Again, I'm Justin Hitt with InsideStrategicRelations.com. Actually, that's another website. You can contact me there or at Sustainable Wealth Secrets. A lot of these things are drafts. I'm sitting down here. I've got a rice cooker going behind me. You heard the beeps earlier. I've got my little outline here for the podcast. Debt management is critical if you want wealth. It's critical if you want to gain influence. But again, a lot of you guys put too much effort into it, and you have these elaborate spreadsheets and business plans. I'm telling you, if you can't work it out on a piece of paper to explain why you're borrowing money, then you shouldn't. But there are times that you can get a very effective first draft on paper that says this money's going to take you to the next level. And it is easier to borrow $1 million than it is to borrow $100,000 sometimes. But ultimately, you got to understand these concepts. You cannot be afraid of a little bit of debt. You can't be afraid of that investment. It's just money. It's not magic. It's if you're partnering with a bank in order to buy your home, that's a liability. Your home costs you. You're basically, the bank is letting you go find a house which will increase in value, and then letting you borrow money and maintain that house, and then if anything ever happens, you'll give them the house back. See, you're kind of getting screwed there. So when you find a good opportunity, such as a rental property, a business, investment in your education, investment in your, I'm not talking about student loans, but investment in being able to get to that next level, the bank will be your partner because you're going to do all the work. But that's great, because if you have the upside figured out in advance and you've hedged and you've set up a plan, you'll come out as well. Anyway, I'm Justin Hitt with Sustainable Wealth Secrets. If you have any questions, visit me at www.sustainablewealthsecrets.com. The other website, Inside Strategic Relations, about building business relationships. But either way, I'm here to help you transform business relationships into profits guaranteed. And we've been talking about the power and the reasons you might want to borrow tremendous amounts of money right now. Thanks for listening. Bye-bye.